Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today we're going to discuss ways that you can become a better investor by avoiding some of the common mistakes that are made. We've all made financial decisions that in hindsight we wish we could change, and that's okay. In fact, it's part of the learning process. The investing world is complex and ever-changing, and even the most seasoned investors can fall into traps. So if you made some of these mistakes before, you're not alone. Consider this a reminder to reassess your strategies and hopefully avoid some common pitfalls in the future. Now, you might be wondering, why highlight these as mistakes if sometimes they actually work? And it's a fair question. While it's true that some of these strategies might yield gains sometimes, maybe even often, sometimes the gains might be short-term gains. Sometimes it may look like it worked out like a charm, the decision, but often they don't hold up, and a lot of times the risk is too much. So as a financial advisor, I try and steer people from looking at probability, taking risk into account, and obviously driving towards investing under sustainable and long-term growth under what makes sense for what someone's trying to do. So, throughout my years in working in this industry, I've worked with a lot of different clients, each that has their own unique investing journey and thoughts and experiences. So from that experience and also from formal and informal training, I wanted to identify 5 common mistakes that I see investors make. So, like I said, whether you're a seasoned investor, you're just getting started investing, dipping your toes in, hope you'll kind of join me as we explore these mistakes, and then obviously more importantly, how to avoid them. So the first one is called falling into the fear-greed cycle. So there's an old saying on Wall Street: financial markets are driven by 2 powerful emotions, greed and fear. And no, it wasn't said by Michael Douglas in the movie Wall Street, but actually by legendary investor Warren Buffett in his 1986 letter to Berkshire Hathaway shareholders. In that, he wrote that occasional outbreaks of those 2 super contagious diseases, fear and greed, will forever occur in the investment community. Investor behavior, it's primarily driven by fear and greed, and it's responsible for the dizzying highs that we see in bull markets and subsequent crashes that we see in bear markets. So, let's take fear. So, during times of uncertainty, market downturns, things that you're hearing in the economy and the markets, it can grip investors, and it leads to panic selling and, or a reluctance to invest. And, it can stem from various sources. It can be economic instability. It can be geopolitical tensions, negative news headlines, really anything. And when fear does strike, investors, they a lot of times make impulsive decisions based on emotions rather than sound financial analysis. And a lot of times when they make those decisions at the times that they're making them, it's like the inopportune or the worst time to make those decisions. So it's important to know that it's normal to feel fear. And, we'll talk about greed in a second. But you really have to keep your emotions in check. And, the fact that you're feeling those things, it, just says that, it just lends itself to that you're normal. Now, greed, it's conversely, the opposite of fear. And during periods of market optimism or rapid growth, greed will take over. Investors will chase these higher returns. They'll buy things at all-time highs. They'll engage in speculative behavior. And in here, it can lead to overconfidence, willing to take excessive risk than someone should or needs to do in the pursuit of profits, in pursuit of beating the market. And this mentality can contribute to asset bubbles, which can eventually pop, irrational exuberance, which is a term coined by Alan Greenspan, a former Fed chairman. And, this type of behavior widespread can lead to market corrections or crashes. So understanding the fear-greed cycle, it's important to, for investors that you have to maintain your discipline. You have to avoid making emotionally driven decisions. And if you can recognize these psychological tendencies, investors, you can maintain a rational approach to investing when you focus on your long-term goals rather than short-term fluctuations in the market. And I have seen people gotten a little better with this just because they've been exposed to some of these market fluctuations, whether it was a crash during COVID or even 2008, 2009, and people some people went through that fear cycle and sold everything in 2008, 2009 during the financial crisis, only to see the markets come back shortly after. And shortly can be a relative term. I guess when you look at COVID and you see that there was a big crash in March of 2020, and a couple of months later, the markets had already recovered almost the entire amount that they had crashed. So people are starting to learn kind of how these markets operate. And yes, there can be downturns, there can be crashes, but also there's still a lot of people that kind of take that fear side and take it to extremes. And then I see it a lot more on the greed side, where markets are making new highs or stocks are making new highs, and you kind of think, okay, there's no way that this can ever go back down. This only is going to go one direction and go up. And in reality, it's not always true. All right, so that leads us to our second mistake, which is called action bias. So with action bias, it's common for people to think that more action equals more progress, especially when it comes to investing. But the truth is, successful investing, it requires a lot of times patience and discipline. So generally speaking, on the investing side, there are two extremes of the way people invest. There's one strategy called set it and forget it, which is you pick your investments, you set them, and you never touch them again. Or you can actively trade them, whereas you're making trades frequently. It could be daily, it could be weekly, but you depending upon what's going on in the market, you're changing things, you're buying things, you're going to cash, you're selling. Now, the second option, this actively trading, sometimes people call it day trading, where they're trading in positions every day and getting out of these positions. That's obviously more of an extreme. Now, the way we approach it is somewhere in the middle of those two extremes. We like to come up with an investment strategy, but we do make changes to the investments when they're warranted. An example I can give is that in 2022, it looked like inflation was starting to pick up in the economy. So we shifted some of the assets and some of the portfolios that we manage into asset classes that do better in inflationary periods than others do. Now, in 2023, when it looked like inflation was starting to peak, we shifted out of some of those investments and into ones where there was more value in them. And I use the word shift because it wasn't wholesale changes. We didn't sell everything in the account or in a portfolio and put in these inflationary type of investments, but we did make shifts where we're just trying to gain an advantage, whereas, there wouldn't have been one otherwise. Now, there could be shifts with sectors, or there could be shifts with international versus domestic or US-based stock. There could be shifts between fixed income and equities, shifts between small cap, mid cap, large cap stocks. There's different ways of doing it. But again, it's what we're talking about here is the bias between action and that. All right, if someone's not making a change, then they're not making progress and they're not making a difference to it. Now, not being this actively day trader can spook some people off. They think if there's no action, there's no advancement, and that they won't make any money. There's I don't even know I guess he's kind of like a financial coach out there called Grant Cardone. His philosophy is taking massive action. And I definitely think that's a great approach in some areas. In investing, it's a little bit different. So you can still achieve your financial goals without having these daily or really frequent actions. Because a lot of times when people take action, they go to either that fear-greed cycle that we saw in mistake one or some of these other mistakes that we're going to talk about, and they can screw things up. They may sell things early. They may sell, things at lows. Actually, kind of a funny study that Fidelity did, it revealed that investors with the best results were often the ones that took a more hands-off approach. And it classified them into the hands-off approach into two categories. Either they lost their password to their online account and they couldn't actually make the trades, or sadly that they died. And they obviously are not logging into their 401ks and making changes. Like I said, we make changes when they're warranted. We'll also change when we rebalance accounts, when strategies shift. But again, it does not have to be something that's constant to be successful or to be able to reach your financial goals here. All right, so now let's move on to mistake number 3, which is recency bias. So in behavioral economics, recency bias, it's the tendency for people to overweight new information or events without considering the objective probabilities of these events over the long run. So recency bias matters for financial markets, as the memory of recent market news or events, it can lead investors to irrationally believe that a similar event is more likely to occur than what its objective probability really is. So this leads us to investors making mistakes. So let's look at an example outside of financial markets and investing. A well-known example of recency bias is that people tend to overreact to news of a shark attack, which obviously is not a good thing. And yes, it is good to be nervous about shark attacks, but shark attacks, and especially deadly ones, they're extremely rare. And they do happen. But it's just killed a handful of people each year. So in 2022, there were only 57 reportedly unprovoked shark attacks worldwide. Nevertheless, many people or less people swim in the ocean following reports of a shark attack. So because people believe that the odds are far greater of them getting attacked by a shark than they really are. So for investors, recency bias, it affects the trading decisions that people make based on recent news or headlines, expecting those events to be much more frequent than they actually are. So for example, during a market crash, people they can adopt a negative outlook that assumes a bear trend will continue, even though the drawdown will maybe just be a correction. Or during asset bubbles, when prices reach levels that are no longer supported by fundamentals, people may continue to buy under the false belief that the rally can only go up, it can only continue. The same thing happens with specific companies. When one company is performing well, people tend to believe it will continue to do so. When one company is performing poorly, people tend to believe that, okay, this stock is a dog, it's only going to go down. And I see this a lot where people will look at their portfolio, they'll see, okay, I have some winners and let's sell the losers. And they may look at a stock that's a loser, but it only hasn't done well when you look at it over the last, let's say, 3 months or 6 months, when over the last 3 years, it was actually one of the best stocks in the portfolio. Obviously the same is on the flip side of a stock going up. Just to give another example, in 1980, the companies with the largest market caps were IBM, AT&T, Exxon, Standard Oil, Shell, GM, and Texaco. None of those are in the top 10 today. Now, I know 1980 to now, it's over 40 years. So we're looking at a large amount of time. But if you think about it, it would seem unfathomable that companies like Apple, Amazon, Google, Microsoft, who are kind of at the top of the market cap now, that something would change and they wouldn't keep their domination or their dominance for years to come. But you just have to remember, anything is possible when it comes to investing. Recency bias can be difficult to counteract because our brains are wired to put more emphasis on recent events that are fresh in our memories as older events fade and we kind of forget about things that have happened. So one of the I guess kind of ways to combat recency bias, it's to have an investment strategy, stick with it, be disciplined, regardless of, the short-term market volatility or what, short-term events or things that happen in the portfolio. You kind of plan in advance to rebalance your portfolio, meaning like, okay, I'm going to change my portfolio when the actual allocation shift, 10% from what the strategy is, or I'm going to do this every quarter or every month or whatever time period, no matter what happens, and taking that approach. Or I'm going to, invest in my 401k, at 1% per month, rather than saying, okay, I'm going to wait till there's a market drop and then I'm going to invest, or I'm going to wait until this happens or that happens before I invest. All right, that brings us on to mistake number 4, which is the sizzle. So investing, it's not just about like crunching numbers, doing analysis, looking at charts. It's also about navigating the noise in the market. And nowhere is that noise louder than what I call the sizzle. So the sizzle is a term I've given to the allure of the latest and greatest investment trend. And, it's the shiny objects that captivate our attention. They promise the massive returns. Whether it's the buzz around AI, cannabis, water companies, or the newest tech company. The sizzle draws us in with that promise of these untold riches, or, it's a way I can get rich quick, or I can retire off of the gains in here. And while the megatrends sound tempting, they often lack that solid foundation needed for sustainable investment growth. Sure, they make headlines, they generate excitement around friends and family, and they're cool to talk about. But when it comes to building that robust investment portfolio, chasing the sizzle can lead to disappointment and lower market returns. Think about it. How many times have you heard about the next big thing only to see it fizzle or fail to live up to the hype, or okay, this is going to take hold and next year this is going to be the biggest thing, and yeah, maybe it is the biggest thing, but maybe you had to wait 10 years for it to be the next biggest thing, whereas your portfolio could have made money in some other type of investment. So not saying you shouldn't avoid innovation, or emerging industries altogether. Some of the most successful investments have come spotting trends early on, so that's fine. But the key is to approach those opportunities with discipline and even a little bit of skepticism, rather than blindly jumping on the bandwagon because you hear about how good things are going to be or how positive it's going to be. One example I like to give is 3D printing. So maybe about 10 years ago, 3D printing was the entire rage, and everyone was going to have 3D printers, and where everyone was going to be 3D printing organs and this and that and everything. And yeah, maybe that's going to come down the road, but you would have lost out on a lot of market returns if you would have kept your money in these 3D printing stocks, over those past 10 years. So instead of chasing the sizzle, build that, portfolio, whether it's diversified or, solid, well-represented industries, that have a proven track record of success. And like I said, it could still be innovative companies, but you don't want to go chasing the euphoria around the sizzle. And then even if you are going to chase the sizzle, that's fine too. But make sure you're doing it smartly. Make sure you're doing it with a portion of your portfolio that makes sense. Because, I see a lot of times someone will go after that sizzle company and they'll get a taste of success, and then boom, it's okay, I'm going to pour everything into that. So let's go over the last mistake that we'll talk about today, mistake number 5, which is reaching for yields. And I'm going to talk about this in the context of dividend investing. So dividends can be really appealing. I love dividends. They're great for investors because they generate steady income, retirees needing to supplement their retirement funds. But you have to take into account, not all dividends are created equal. And when it comes to dividend investing, it's natural to be drawn to the ones with the highest yields. So you can see this stock is paying a dividend over 10%, or this one's paying 12%. But reality is those high yield dividends, they can sometimes be a trap. So companies offering that sky high dividends, they may be doing it to attract investors because their stock price is in the toilet or it is down, so they need to do something to get people to invest in the company. But they might be offering that dividend at the expense of the company's long-term financial health. A lot of times the company is paying out more dividends than they actually have in cash, and they actually have to take out loans or debt to pay those dividends, and it's not sustainable. It can lead to worse company performance, worse stock performance for the company, and in some cases it can lead to the company going bankrupt. So when it comes to evaluating a dividend-paying stock, you want to look at 3 specific things, and these are all beyond what's the yield of the actual dividend that it's paying. So first, you want to look at the payout ratio. So the payout ratio, it's the total amount of dividends that a company pays out to shareholders relative to the company's net income. So obviously, net income is the amount of money that it's bringing in, and that should be, that's what a company should, without taking on debt, should be able to use to pay out dividends. So it's a ratio of the percentage of earnings paid to shareholders via dividends. Really generally want to look for the lower the payout ratio, the better. That means they have this, at the end of the year, they have this pool of money that they've earned, and they're not paying out a large percentage of it as a dividend, because obviously the more percentage of it they're paying out as a dividend, the less buffer they have if they run into some kind of financial problems, and they need those earnings, they need that cash to support themselves. So I usually look for something less than 60%. You want to look for a company that's paying out less than 60% of their net income in dividends. Next is the total return of the stock. And this is kind of something that I was talking about a little bit earlier, is don't just focus on the yield, focus on the yield plus the market return of the stock, right? What's good is a 10% dividend if the company stock price dropped 20% that year. You're at a negative 10% for the year. So, you want to look at how is the stock and price, is it growing? Hopefully. If a stock price is growing and they're paying out a good, healthy dividend, that's really a sign of sustained strength that a company is. So you really want to look at the total return of the stock. And then last, you want to look at companies that raise their dividends every year. So if this year they're paying $1 in dividends for every share that someone has, you want to see them next year pay $1.10 or $1.15 or even $1.05. It doesn't have to be they pay $1 one year and $5 the next, but you want to see companies try and make this list of ones that raise their dividends every year, that have a streak of raising them every year and don't break that streak. So even in times where there's financial instability, a sign of strength is if a company, one, doesn't cut their dividend, but two, if they're even able to raise it in those periods of time. So you have different classifications of these dividend payers called aristocrats, kings, dividend queens. They're ones that constantly raise their dividends over some 10 years, some 20 years, and some have even raised over 50 years straight. So it's really a sign of strength of a company that can do that. So we just covered kind of some traps on dividends, but I want to reiterate, you shouldn't, this is not to say that you should avoid dividend paying companies. It's far from it. I'm a big proponent of dividend paying companies. I think a lot of times people like the tech stocks, but they often get overlooked sometimes, it used to be back in the 90s and the 2000s, no, tech stocks wouldn't pay any dividends. Now they're actually paying dividends, and they kind of get ignored on the dividend side. So there's a lot of different flavors of dividend investing that people should look at. You just got to be careful and don't, always reach for yield and look for the one that has the highest dividend. All right. So with that, we covered the 5 investing mistakes that people make, or you may not even realize that you're making. I'm reading a book right now. It's titled Mindset, and it talks about how people can take a growth mindset where you're always trying to learn, always trying to challenge yourself, or conversely, a fixed mindset where you believe your abilities or intelligence can't be changed. So investing is definitely one of those areas where we should take the growth mindset, always be learning, always look and see how can we make improvements or how can we be better in how we're doing it. So thanks again to everyone who tuned in today.
Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.